Here's the problem with only disclosing contribution margin. I don't really know why they had 174% growth. Now that they're public, they know they're going to get hammered even more if they do disclose it. So now they're hiding this stuff. Me as an investor, that's a red flag to me. Uber and Lyft have recently gone public in the past few months. They are going to really have kind of their first earnings release coming up in the next few days here. And Uber is going to take a big write down for really just the cost of the stock that they've now issued. And so that's a one-time thing that doesn't materially affect the actual business. Let's jump into the numbers here because there's a lot of different numbers. But ultimately, I think what people are trying to figure out is what kind of winner-take-all market is this? I think everyone says, yeah, Uber and Lyft ride sharing, it's a winner-take-all market in the US. I think what people are asking themselves, if you're an investor, you're trying to say, is this more like iOS or Android, where it's kind of like a 50-50 split and the two dominant players are more close to one another in their dominance? Or is this more like Google search and Bing, right, where Google has 70-80% market share, and then the second player is a far less superior second player? Still both winner-take-all markets, but a very different composition of them. How would you kind of break down the dynamics of this? How do you kind of look at the ride-sharing market, Nick?
I think the challenge for ride-sharing is, I think the CEO of Lyft may have said this at one point, is basically once you get to availability down to about 3 minutes, then the additional network effects from there sort of diminish. Really, if you can get someone a ride in any area, then a few minutes going from 3 minutes to 2 minutes and 30 seconds isn't much of a difference, and not one that makes a material difference. So I think that if you're looking at ways that this might not be a winner take all and where they might be able to get close to each other, it would be in those areas where they can both get basically similar levels of capacity and supply, such that they can both kind of reach that sort of threshold where that might kind of attenuate the winner take all dynamic.
Yeah, and I mean, Uber now isn't just one platform. They are becoming a platform conglomerate. They have obviously Uber Eats, which you can see here. Uber Eats in their most recent quarter accounted for about 21% of the core platform gross bookings. So this $14.5 billion in GMV is split about 20% Uber Eats, 80% ride sharing. Also, if we scroll up, this is from the earnings release. All gross bookings are about $14.65 billion. Basically, that other $140 million in GMV is basically attributed to the other bets that they have going. Uber Freight, the scooters business, any kind of like new different mobility services like drones and things like that. I don't think there's any revenue there. But point is, they're becoming a platform conglomerate, and Lyft is just really focusing on being a ride-sharing platform. Right. Very different structure of business and scale, and just way that, if Dara is focusing on the bets that he's making and how he's allocating capital, it's a very different environment than a Lyft. Do you think that puts any of them at a certain advantage or disadvantage?
You typically see that with the dominant player going into multiple businesses. If you're in a second place position, you tend to not have the ability to expand beyond that, simply because you're just fighting for market share. I think so that indicates to me that Uber feels pretty confident in its position in ride sharing, and certainly domestically. I think the other thing that does is creates these kind of interlocking network effects, particularly for drivers in the Uber Eats example, where I might not be able to get a ride right now, but I can go deliver food. So it gives you kind of different opportunities to make money in the platform. And I think that only strengthens their ability to keep that supply in there.
Yeah, look, I'm pro Uber, right? I'm long Uber. I think it doesn't mean I don't think Lyft is going to do fine and will break even and will be a profitable business, which I've heard some people say they don't think Uber can be profitable. I don't believe that for a second. I think you can have a fine, profitable ride-sharing business, even if you only have 30-ish% market share. Lyft is saying they have 40% market share today. Even if that comes down, I think they can still eventually, there's still a lot of growth in general in ride-sharing in the United States. And I think they can both have a profitable, fine, growing business that, if you look at their stock price today, will still make the average investor a fine earning on that investment. But I think if there's who is going to be the winner or who has more kind of upside to it looking forward is Uber. For that reason that they are moving into platform conglomerate status, and they're going to be able to use these different network effects from Eats and other things to just further lock in their both consumers and producers. But also let's look at the numbers here. And the numbers have honestly been a little bit confusing to me. And here's why. So we have done a lot of analysis on platforms in Platt, in the ETF, looking at Bloomberg data, looking at eMarketer, e-commerce market share data. And basically the concept of GMV, gross merchandise value volume, is not properly understood by the analysts, by the investment community. And I think part of the reason for that and part of the fault lies on the actual platform companies for not being as open or transparent as they should be with GMV data. So Lyft pre-IPO was disclosing their GMV. Then they said, hey, once we go public, we're not going to disclose GMV to you anymore. We will disclose to you our contribution margin, which is essentially, hey, if we do $1 billion in GMV, how much revenue do we get on that billion in GMV? Is it maybe $200 million? So they're going to have some take rate on the billion, and that's contribution margin. Their contribution margin for their previous quarter was $384 million, and that grew 174% from that same quarter the year prior. So year over year growth, 174%. That's a lot of growth. Here's the problem with only disclosing contribution margin. I don't really know why they had 174% growth. Is that 174% growth more a mechanism that they raise the take rate from 10 to 20%?
Right.
Or is it more a mechanism that they've been able to expand gross bookings?
Or they're reducing rebates and bonuses and that kind of stuff.
And I should know that as an investor. You're a public company. Your bigger competitor, by the way, is disclosing gross bookings.
Right.
And so me as an investor, that's a red flag to me. Why are you taking away this very important data point from me as an investor to be able to make a decision? Okay.
It's very unusual for a marketplace business to not disclose GMV.
And then I dig deeper, right? And this is why this red flag becomes a much bigger warning sign to me. So $384 million in take rate. I don't know. Let's assume that that's 20% take rate, which I think is somewhat generous. I think many Uber drivers, and I have some friends that kind of have like little mini Uber driver businesses, will say that Uber is probably taking like more than 20%, maybe 20 to 30%. But they are calculating the net fee. So that's take rate plus like insurance fee and maybe like rider convenience or protection fee and taxes. And there's other stuff baked into that. I think purely if you're looking at what is the take rate, I think a 20% is a pretty safe assumption, conservative assumption. Right. So let's back that out. That gives you $1.9 billion in GMV. Now, for 2018, the full year of 2018, Lyft reported $8 billion in GMV. So usually, right, you have strong quarterly growth. If you look at Uber's quarterly growth here on gross bookings, it's strong quarterly growth, 20, 30, 40%, year over year growth here. These are strong growth metrics. So that doesn't mean that if you have $8 billion in GMV, Q4 for Lyft is at $2 billion. Let's say Q4 for Lyft is around, say, $2.3 billion in GMV in 2018. So now if I'm trying to say, what is Q1 GMV for Lyft? And I know they've, maybe got $1.9 billion in GMV. They have another $300 million or so in linear revenue. Linear revenue from these ride-sharing companies would be attributed to, when you do Uber Pool, that's not booked as GMV, that's booked as actual revenue. Uber got into a whole snafu about how to report this properly, but they're booking that as linear revenue. So there's some mix. That's why the GMV number is so important. So let's assume that Lyft had the $1.9 billion in GMV from pure regular kind of ride-sharing, and then another $300 million from like the Lyft pool, Uber pool, whatever Lyft calls it. I don't know. That would give them around, say, $2.2 billion in GMV. That doesn't seem like much growth to me, even if my numbers are off by $100 million or $200 million. If you're only growing 100 million in GMV or 150 million in GMV from Q4 of 2018 to Q1 of 2019, that makes sense why Lyft stops to disclose this number to investors, because the number doesn't look good. Let's look at Uber's numbers here, okay? Uber is doing $14.5 billion in Q1 GMV, okay? Quarterly, okay? Massive. Now, this is global. That's the thing we need to understand here. That's $11.5 billion just from ride sharing and GMV if you take out Uber Eats, okay? When you look at what Lyft is saying is that, $8 billion in GMV in 2018, we had 40% market share. So if it's a total $20 billion pie for 2018, and Uber doesn't break out exactly what their ride sharing is from the US market, but that's saying, like, is Uber doing $12 billion in GMV in 2018 in the US? Look at these numbers. Absolutely. Uber's doing $11.5 billion in ride sharing globally in a quarter. And then you say, okay, basically, are they doing at least 25% of their ride sharing GMV from the United States? Roughly. That's going to put them at, that would then fit with Lyft's number. I think that sounds low to me, in the sense that I think Uber is doing much more GMV in the US than $12 billion for 2018. I think Uber, they bought Careem for $3 billion in the Middle East. They do have a lot of GMV elsewhere in the world. I don't think it's 25% of their overall GMV is coming from US ride sharing. That seems low. And the US is a massive market for ride sharing, one of the most mature. This has been going on the longest, basically be like US and China. But now Uber has exited their Chinese business, and that was wildly profitable for them and absolutely the right decision for them to do. So to me, this looks more, I think Lyft knows that it's not, if it continues to show investors apples to apples numbers, Uber to Lyft comparison, they know it's not going to look as good.
Right. If it were, they would be doing it.
Right. And now that they're public, they know they're going to get hammered even more if they do disclose it. So now they're hiding this stuff. And I think when you look at the Uber numbers here, they're strong. When you look at Dara and you look at his leadership and you look at his experience coming from Expedia and you look at the investments they're making as a platform conglomerate and what that does to their positioning and just power in the ride sharing business, as we talked about when we first started this, I'm long Uber. Now, that's my financial analysis. Here's my personal anecdotal story as to why I'm long Uber. Okay. I was a Lyft guy. Why was I a Lyft guy? Because I'm a big Delta guy. Lyft had a partnership with Delta. And what I would find is actually, more people were on Uber over the past few years. And actually sometimes I get better prices on Lyft just because I think less people knew about Lyft and the whole thing. So I would go Lyft. I would get, some points on Delta. It was nice. Fine. Then Uber a few months ago came out with loyalty programs and said, buy an Uber pass. And I will basically get rid of surge for you. I will guarantee you, rates on your most traveled routes, all this kind of stuff. I'm an Uber guy now. I get locked in rates. And then Lyft followed maybe like a month or two later on their version of the pass. And this is to me is just one example about how the dominant platform, now the platform conglomerate, is going to be able to, at the edges, right, of innovating, it's just going to be able to innovate a little bit faster. It's just going to have a little bit more resources, a little bit more balance sheet that they can use or muscle to kind of seed these programs, maybe lose a little bit of money in the beginning while they figure out the economics. But I don't use Lyft anymore. I just use Uber. And I used to love Lyft. And, it's nothing against the brand or anything. But it really just came down to the economics and then this program. Yep. And then they get you with, you've been so great on Uber. Here's your coupon to go use Uber Eats. 15% off. And then they bake in all these other things. And that to me is just a great example about how they sprung me out of the Lyft flywheel, and into the Uber. And so I think that's not just happening to me. I think it's a great example of platform, of being the number one player and how you can use that power to your leverage.
last point on this, Nick?
The leverage that Uber has as both the number one player and having all these interlocking ecosystems will definitely help them long term. I think the only place you would get into trouble is if they don't succeed in the food business. It's a very low margin business with a lot of competition, DoorDash and others.
Mm-hmm.
They may there is a future scenario in which they might decide, oh, we're going to exit this business because we can't make money here.
Mm-hmm.
But short of that, I think that they're in a strong position.